A warm welcome to Karthik Balakrishnan from Rice University, but currently visiting London Business School.
Yes.
And we are very, very happy to see him. Some of you may have attended his talk when he was here visiting at IIMB for a few weeks. And the paper on banking and liquidity shocks. And right. Very, very happy to have him here. He's going to talk about disclosure regulation and then managerial myopia and signaling in one paper, all of it in one paper. So the rules of the game, Karthik, is the first 5 minutes are all yours for you to summarize the paper, and then we open it up for questions. So anybody can ask a question, but generally what we request is the audience is to either do the hand signal or send a chat message to me privately or everyone, and I announce that somebody has a question, and the question will get asked. Right? So it's free for all after 5 minutes.
Thank you so much, Srini, for inviting me, and thank you all for being here this evening in India. As I was thinking, and I was mentioning to some of you here, I was thinking, well, Friday evening accounting workshop is probably not the most interesting, so we'll do the best we can. And it's always great to present to this crowd. As Srini mentioned, 3 years back, I had a wonderful time spending about 1.5 to 2 months at IIM Bangalore campus. We cherish every minute of that, my wife and I. And there's always that lingering thought that comes up at this stage, we should go back to India. And so IIM Bangalore actually made it even more appealing for us to sort of think about India. So we had a great time. And so this time I've come with another paper. So let's see how that goes. I'm just going to share the screen. Just 1 second as I get that up. So as Srini rightly pointed out, when the title is too long, it means that the authors are not 100% sure what they're doing. So that's a problem for our paper as well. We are going to try to, the problem is not, unfortunately, the problem, it would have been better if the problem was only with the paper. But I think the problem is more pervasive than just the paper. It's actually the way this literature has grown that causes the problem. And so I'm going to lay this problem out. And then I have 5 minutes, so I'll try to wrap the paper summary. In fact, I didn't plan for a 5-minute summary, but I can try to set up some motivation, and then feel free to ask questions. I don't have any problem with that. So there has been a lot of discussion on this notion of corporate short-termism or myopia. And it's everywhere around, right? You go to, you pick up newspapers, they always say, and you have investment managers talking about it sometimes. You got politicians talking about it. And there's always this feeling that capitalism has sort of increased short-termism. And so if you want to have a technical definition, corporate myopia, the US companies as a group, not a single US company, but as a group, underinvest in capital expenditures as well as research and development. That's the myopia problem. And why do they do that? That's because it benefits the companies in the short run and harms the companies in the long run, where short term is generally defined as 1 year ahead or 2 years ahead, and they're trying to maximize stock price, right? And so this is a very popular argument that's made, and people have started forming regulations based on this argument. Everybody accepts that corporate myopia exists. For example, this is Paul Polma, who was the CEO of Unilever, and he has been championing this problem that corporates should not have the short-termism problem. So in other words, he assumes short-termism exists, and then he says corporate should not succumb to the short-term pressure. For example, when he took over as the CEO of Unilever, he stopped giving any guidance, right? So he stopped giving guidance. And in a recent speech to broader audience, so now he goes about talking about short-termism to different audience. In this group here, he's mentioning a couple of points. He's saying, well, we are running companies into the ground with short-termism, this myopic focus on shareholders. There is no question about it, especially when you think that 50% or more of investments create value for a company only 3 to 5 years out or so. So his point has always been there is too much short-termism that comes from investors, and corporates have to stand up against it, as if they can't, right? And Christine Lagarde, the IMF's managing director and chair, also said something similar. The financial sector prioritizes profits over long-range prudence and short-term over sustainability, and that's what is happening. The question is whether this is an overreach, right? Are we making sort of a hill or a mole out of an anthill sort of a problem, right? Mountain out of an anthill, excuse me, problem. And so to give an opposing view, we got a recent paper by Stephen Kaplan, who's at Chicago, and he had, this is a thought piece, this is not an academic work, but he lays out some arguments why this isn't even a real problem. And it's something that's fictitious, it's political, just like how the Donald Trump era or where they create populism, where they create an issue and a fear out of nowhere, and then you bring regulations to clamp down. He's trying to say that it's probably that. It's not really corporate myopia. So for example, he says, if you look at corporate myopia, the criticism has existed not just today, but if you go back 35 years, 40 years. And then by all measures, you look at how growth rate has been, how GDP has grown. If it is underinvestment 35 years back, we wouldn't be here today at an aggregate level. And he goes on to provide multiple arguments for why that might be so. The second line of sort of reasoning that he brings in is that even if, let's say that there is pressure coming from a group of investors, then it's great. There are other groups of investors like private equity and venture capital who could actually step in and make a lot of returns by filling in those investment voids that people claim are not being captured. Right? So it's very easy. If, let's say, Unilever misses out on an opportunity, there will be another startup that comes in and capitalizes on that. So in the aggregate, is there really a short-termism problem? Right? That's a question that, and so he tries to bring in a few other thoughts, and we can discuss as we move along. So the key problem is that there are some, and this is reflective of also academic work. Think about in the 2005 to 2015 range, there has been lots of papers that promote this idea of short-termism, and they try to provide evidence on that. There is only one theoretical model, which we can talk about a little later, and it rests on a very critical assumption. And it's that critical assumption that we want to take to data and test. The critical assumption for all the short-termism arguments, and especially the one theoretical model that is out there, is that managers cannot communicate value. Because if they can credibly communicate value, stock prices will immediately reflect that value, and you don't have a short-term problem, really. So the key assumption for myopia to exist is that managers cannot communicate value. And so the goal of this paper is to say, is that really true? We have all these papers on signaling that says managers can credibly signal value. Why can't they do that? Do they do it? To what extent do they do it? And that's really the problem, the paper, excuse me. And we show some evidence to the fact that there is a sizable amount of companies that actually are fending off these kinds of myopic pressures, and it's not really a big issue. So to take an example in terms of academic studies that have put forth arguments for myopia, there is a very famous Graham et al. Survey where they survey 401 financial executives, and they find that 78% of them would sacrifice long-term value to smooth earnings. And we use this all the time to talk about earnings management and all these consequences of it. Now, it is possible. We are not disagreeing that managers would tend to do it, but equally, there is an opposing force, right? When you're going to have short-term pressures, it is also going to keep managers on their toes. They are going to be more efficient to survive in the market. So the net effect is an empirical question. We don't know what prevails and when. And so we need, and so what's now coming out of this initial debate, so there was a lot of extreme populist view that there is a myopia, and now we are taking a more nuanced approach towards understanding and appreciating as academics, it's not as obvious. We need to really understand what causes it, when it causes it, and what are the conditions when you can sort of ameliorate any negative effects of some regulations or some pressures that come from the market. So here is one interesting recent, again, a thought piece that we have by Alex Edmonds, who was my colleague here at London Business School. And what he said was that it's very tempting to make, and so it's very interesting in that he accepts that when he started out in his job market paper in 2007, the first sentence he wrote was that short-termism is destroying capitalism and the markets. And then now, this is his take. It's tempting to make sweeping, unqualified statements, that is, all firms are short-termists, as these are likely to be turned into headlines. Moreover, the view that short-termism is a universal and pervasive epidemic has supported for calls that increase regulations, right? So you're just throwing the baby out of the bathwater by destroying the current system and not quite understanding where the benefits and the costs are. So the key point is short-termism as a concept is a nuanced problem than the media and the politicians are making it out to be. And in fact, even academics to some extent are making it out to be. And so we need to debate and sort of reinforce the need to take evidence-based approach and sort of think about, okay, when does it really work and when does it not work, right? So that's sort of where we are coming from. And so rather than have a paper that says short-termism exists and short-termism does not exist, we want to be somewhere in the middle and say, here are some reasons why or when you can observe this problem. And here is what managers do and can do when they see this problem. And so that's what we want to talk about. And you can tell us whether we get that far or not. So again, feel free to ask questions at any point. Okay, there's no stopping. Okay, so you can go for it. So I'm going to go.
Sorry, Karthik, maybe I'm jumping here.
Yes.
When I read the paper, or what I realized is your specification. I'm just jumping to the regression.
Okay.
But not the empirics. I'm just trying to state the regression in an economic way. Is that what you're trying to show is myopia? You're not trying to prove myopia. Just to be clear, you're not trying to prove myopia in any way. There's no test of myopia. But you're saying when incentives to become myopic are high, then managers will signal. Is that the correct description of the paper?
Absolutely. The first part of that using the exact same pressures to be myopic, there is one other paper that shows that there is a cutback on innovation and there's a cutback on investments using a couple of measures of investments. And I'll talk about that. So it's the exact same setting we are using. So we are taking that corporate myopia in this setting has been shown, but the flip side is you need to also show that during these settings, there is also signaling. So it's the net effect of so I don't do anything at the aggregate level. It would be nice if someone comes in and takes both the evidence from our paper and the evidence from the other paper and say, okay, now where do we stand net in the economy with respect to, let's say, this setting? For that, what we need, unfortunately, is data from, say, private firms also, because what's been missed out as an opportunity from public firms would have gone into the private sort of businesses. And we don't have a good handle on that. So you're absolutely right. So what we show is that when there is a pressure to be myopic, there are managers who try to credibly signal value. They do signal value, and they find that the market reacts to that signal, and they go on and they make some, well, we don't show that last part, which we probably would want to show, that they make those investments. We just show it in those settings where investments are high, they actually signal more.
Okay, so let me play devil's advocate here. So this whole thing, especially when I was a PhD student in Wharton, signaling was not viewed with very, they didn't like signaling at all. And all of the time in the PhD seminars and when people gave talks, whenever people talked about signaling, there was a constant echo that, what is the optimal signal? And you need for signaling to work that marginal cost of the signal for the good type versus the bad type, that has to be shown. And there are so many signals. Why are you picking this signal, right? So all those criticisms, don't they apply to your paper? That's right.
Absolutely.
So you're saying you're choosing one signal, and I also have issues with choosing insider trading as a signal, right? It's not exactly a clean signal. So how would you respond to if a referee comment like that? So why did you choose insider trading, or why a signaling story, etc.?
Sure, that's a very critical problem. And so let me take the why signaling, and then I will also get to the measure of signaling. So why signaling? Well, what are the tools for managers they have? And maybe I can start with this slide here, and it's perfect. You just finish the slide, and then I will take that question.
Sure.
The Stein 1989 model. The myopia exists only because there is profit potential from some investment that's going to take a long time to get reflected in earnings. In his model, what Stein does is that he links earnings as the only source of information to stock price. And because earnings is not going to reveal the future benefits and the payoffs from the investments today, managers who are focused on earnings today will not invest. And there is no other way that they can communicate. Edmonds et al. Also have another paper where they trade off hard information and soft information. And there too, they show the same idea that disclosures in any other form, like voluntary disclosures, like earnings guidance or anything like that, may not be a strong enough way for managers to commit to doing the good or doing the things in the long run. So there is no way that they can tell the outside world that the R&D investment that they are taking on is something that's going to bear fruit unless they somehow show their private information. So in all these, the critical argument is that managers cannot communicate, right? So no disclosure is going to work. And that's where signaling as a concept sort of fits in to the model. So in other words, what they are saying in these models is that managers cannot signal value. So that's where we thought there is a role for signaling here. So that's our reason for motivating signaling. So in terms of the arguments that you made about whether signaling is costless, that's exactly the point. You need to have a certain cost to the signal to separate out the good versus the bad. And it becomes sort of an empirical question as to at what cost can you separate yourself. And so I have some anecdotal evidence, and I will talk about it, where managers are committing to buying a huge fraction of the shares outstanding for the company to put their money where the mouth is, sort of an argument. In terms of why insider trading measure and what are all the issues and how we can think about other signals, I'm going to walk through all of those issues if you can give me like 2 minutes. And so I'll go through the second 2 slides and then I can. But any other question on the conceptual?
No, only one comment I'd make is there are other reasons to be myopic. So you try to emphasize signaling in your presentation, right? But you can be myopic, cut R&D to boost your compensation, executive compensation. That's completely outside the Stein model, right?
Correct.
Yeah. So an agency conflict can cause you to be myopic in a lending debt market, agency debt problem. There are other reasons to be myopic.
Absolutely. So we abstract away from agency issues. So in all these, if you think about the short-termism papers that people talk about in the common parlance, and even if you take all these papers that talk about short-termism, they say that the short-termism actually comes from investors, not from managers. Mm-hmm. So that is sort of the starting point that they're keeping. And so this is a pressure that they say comes from capital markets and not because of agency issues or moral hazard issues at the managerial level. So that's a different game that we're talking about, right? So how do you design a contract such that managers deliver value, keeping in account their per consumptions and all that stuff, would be that I am completely okay with. If that's the argument they are making, I don't have anything to say. Which is why we are taking here, managers want to act in the best interest of shareholders and the best interest of the firm. But the problem is there is a group of investors who really cannot appreciate what managers are doing. So it's almost like managers are here having their hands tied to their back. That's the argument that short-termist players are going to make. So they're going to say that it is not the manager's fault, it's the capital markets.
Okay, fine.
And so that's the distinction. So maybe we might want to emphasize, and maybe I should have, the idea that this comes from investors' side. And that is crucial because going back to what you raised earlier on in the introduction, the reason for bringing disclosure regulations into that title, one can talk of it in terms of reporting frequency at the managerial level where, we have more frequent annual reports that we have to publish. Does that cause managers to be short-term oriented? Going back to your point, that's a different, in my view, that is not the short-term problem that people make out to be when they go to these, for example, Christine Lagarde. The focus that she's saying is that the market is fixated on short-term numbers. Mutual fund managers, asset managers are fixated on short-term numbers because they have career concerns. And so that's the number they're going to focus on. And if the company doesn't deliver that, then it's a problem. So maybe what we have to sort of highlight here is that we are focusing on a specific type of myopic problem that emanates from the investor side, where we are abstracting away from the agency issues between investors and managers.
Right.
That we should probably highlight early on. And that's a fair point, that managers themselves are short-sighted because it helps their own compensation and bonus plans. So I agree with that. Yeah, I agree. That's true. That I should sort of clarify. Thank you. Yeah. So that's where we came up with the idea that what can managers do if they want to act in the best interests of the shareholder and they want to maximize firm value, what's the best that they should do? And because these models rest on this assumption of the difficulty in communicating, we thought having a signaling model should work. And so that's what. And so, by the way, Wharton also is completely against short-termism as a concept. So it's actually easy to tell them that short-termism should not exist. But I agree. If the problem is more to convince people outside of this group that theoretically there is no role or room for aggregate short-termism. As you rightly said, the only role is for managers behaving short-term because it helps their own sort of costs. Which is an agency problem, right? And so then we don't have to worry about short-termism at all. I don't think short-termism is a concern when you have a short agency problem. I'm okay. So agency issues one has to deal with, but when people say short-termism, they often try to hold on to the investors who demand managers to be boosting profits. So that's the sort of pressure that we hear from managers. Sure. Like going back to the Unilever anecdote, when Paul Pomna took over as the Unilever CEO, he stopped providing guidance. And he said, I would never provide guidance from now on. This also goes back to your, sort of relates to your point on what measure should you use for signaling. Right. They said, we won't give guidance. And then the question is, okay, what other signals do managers have? If disclosures such as guidance do not work, and managers are afraid of giving that because that it holds them to those numbers, the market. Are there other ways you can communicate soft information, right? Because as a manager, even I would not know when and how much the project is going to return. So my earnings estimates may not be as nice in the next 5 quarters, 10 quarters, but I hope that I'm investing $100,000 today so that it generates possibly $1 million for my shareholders 10 years from now. So how can they signal that? And that becomes the key question. And we thought the easiest way to communicate private information without giving too much details, because then it becomes difficulty to communicate, credibility, and all the issues crop up. We thought the most costly signal that managers can give is if she can invest her own private wealth in the stock of its own company. So that was the angle with which we entered insider trading.
Okay.
What do you think about that line of reasoning?
Yeah, maybe you should go on. I don't want to, I have a few comments, but I'll come back. Let's,
Sure.
move here. And then,
yes. So this is sort of the research question. And here the word investor-driven myopia is more explicit. I should have probably had that earlier on in the write-up also. So our key research question is whether and to what extent managers use costly signaling to avert investor-driven myopia. That's sort of the idea.
So let me just, this general talk, I don't know how it will change your paper or your thinking, but when you say signaling, you have to define the receiver of the signal. So you have to be a little careful and specify to whom are you signaling. And so that's one thing you want to think about. I don't know how it will reshape your paper. So the reason it gets a little confusing is the incentive for myopic behavior comes from the mutual funds changing their reporting frequency. I understand that. So they have to report more frequently. So therefore, they're going to be more under short-term pressure. So etc. etc. But they themselves are the recipients of the signal, which is so it gets very confusing in my head. To whom are you signaling? So in other words, what I'm trying to get at is for the signaling to be effective. So you just show that myopia induces signaling, but to complete the circle, I think you need to show that that signal is effective and therefore causes behavior to change in the market and the share. You started by saying investors are myopic, right? So if the signals are effective, what is the test you show to see some change in behavior, to complete the circle? This is just one part. So there is a stimulus which says investors are going to become more or less myopic, right? The mutual funds in your example. And therefore the managers respond to the signal. So to complete the circle, you have to show that the signal is effective, right? And therefore it alters the behavior of the investors. Then I would be more, it'll be a little bit more credible.
Okay. Okay, I can do that. So your point is that you show that insider. So we went with effectiveness in terms of stock price reaction to the insider signals. We show the stock price goes up, but what you would like to see is that, for example, the same mutual funds are now not liquidating these companies and instead holding on to it for a longer duration than what they would have if not for the signal.
So that's the ultimate test in mind.
Okay, yeah, no, we could do that. That we can do, definitely. We can try out that, definitely, yes. But going back to your question, you're right. So the reason why, and I would probably explain this better when we get to the settings, is that these mutual funds are under pressure to show performance. And when they do that, they rely on the stock price, right? Because their performance is dictated by the stock price movement in the underlying investments they're making. And so the managers of the investee firms have to make some credible signals to keep the stock price high in order to keep the mutual funds in their investor group. The other option could be, and we thought about this quite a bit, that the other option could be, why should they rely on mutual funds at all? Why not let the mutual funds go? And there'll be some other group of investors who come in and sort of fund the project. So that is a definite possibility because shareholders are only one stakeholder. We could also have other ways in which, stock market is not the perfect. I mean, now we have come to realize the stock market is not going to measure value creation for the firm as much because you have so many different groups of stakeholders whom we don't account for. But we thought, okay, at least let's see for shareholder at the shareholder level, are they able to at least do something? So that's sort of the view, but well taken that if we have to show some more on whether that signal is effective or not. We can try to see if the holdings increase.
I'll say one more thing and then keep quiet for a while, right? See, the whole thing, all of this thing is a very obvious thing that when somebody buys shares, the other person is selling shares, right? So if you say that mutual funds are myopic, and they're short. So somebody else is a long-term investor. So on average, who is being myopic is very unclear in my head, right? So it's like when institutions, let's say they feel short-term pressure and therefore they sell out the shares. Somebody else is buying the shares. Either insiders are buying the shares or a retailer are buying the shares. So to say the market is myopic is a little, right? So you have to be a little careful that who is being myopic. I'm just trying to, be specific about who is being myopic, who are they signaling to, is their behavior changing? All of these are, interesting questions which I think the paper doesn't address.
Well, that's a fair point, and
in an empirical way.
Yeah, I agree. That's a fair point. We kept that away from us because we just took it for granted, because we have a stream of papers that are talking about those aspects of the sort of issues. Even in those papers, and your point is taken that somebody is buying from these mutual funds, and so does that still mean that value is destroyed, or are they going to hold on to it and then see the benefits of it, or something like that, right? So, but here is the argument that the other papers would make. They would say that the mutual funds are going to sell out. That's going to reduce the stock price, right? And so you're now, and also the market, the firm is not going to invest in R&D or any of those capex-driven projects that's going to reduce the value of the firm. So in some sense, the value of the firm that is now traded on becomes lower than what it could have been otherwise. Mm-hmm. That's the idea. So nobody is going to gain from this at all, is the argument that the myopia sort of oriented people, they are going to make to us.
Yeah, no, I think, just following up on Srini's point. Hi. Hi. I think the key here is not to pick on one investor type, but more in terms of whether the value of the stock or value of the company is, or whether there is an undervaluation because of the myopic behavior, which prevents the company from doing certain things, right? So I think that that link has to be established as opposed to saying one type of investor is myopic, which I think is, yeah.
Thank you. Yes. Thank you. Yes. Maybe that's a nicer way to put it, in that it's not I'm not focusing on this group of an investor. It is just that this setting allows us to understand the setting clearly of undervaluation caused by career concerns from the investor side. So that creates a problem for the firm in their investment behavior. So that's sort of the idea. It is just that we are using mutual funds and this as a setting to speak to that issue. Yeah, all right. So the inside, and going back to Srini's earlier comment on how signaling can work and whether it works in these settings, there are a couple of theory/empirical work by John and Lang. This is post John and Lang, and then John and Mishra have another paper. And what they do in those, they're all signaling models. And those models allows insiders to change holdings conditional on arrival of new private information, specifically about their investment prospects. So that's why there are lots of other models that are out there about signaling. But in this, there is a joint decision of investment and signaling. And what they do there is to show that managers are able to change their level of holdings in order to communicate value, and that is a separating equilibrium, and that's what they try to show in that paper.
So Karthik, sorry, there's a question from Professor Joshi.
Yeah, sure.
Sorry. Sorry, Joshi, your voice is getting distorted. I don't know if others are getting the same.
Looks like he has an encryption set up on his voice.
Is that the question that you have typed in the chat? So I could just read it out. So I guess I received one question from him. He said, is there a change in the composition of the investors in firms having higher managerial purchase? I guess that sort of relates to Srini and Minky's point. I think just like how Srini was asking for evidence on how the investors change or alter their behavior, it would be nice to show that. I can show, but as Venki was rightly pointing out, our goal was to say that the undervaluation gets corrected more than to show which investors behave how. So we will try to show that composition part of investors. It's harder to observe that, but we just wanted to make sure that the undervaluation gets at least partially correct. So that was sort of the idea with which.
Okay, sorry, I think he's back. Can you try now, Joshi, and see if it works?
Sorry, am I audible now?
Yeah.
Perfect.
Yeah. So I don't know whether this is a question or a comment, but it would be hard to claim these days that markets are entirely myopic, because you don't need to be profitable to be getting public capital. Public capital comes too cheap. Even robust revenues are not required. So that's one comment. The second is that there is this literature which argues that short-term investors are also good for the firm, because that brings managers under pressure to perform. Otherwise, you can actually sort of put money behind vanity-seeking projects and without really having to care about shareholder value. So there is an optimal mix of short-term and long-term possibly to really get the firm to value. I think therefore it's a very complex question to probably get from an empirical setting like this. I don't know. So I was thinking, do you observe, having now brought a greater disclosure frequency to the discomfort of the fund managers, is there any shift in the shareholding? Because the other option for investors is to leave, right? Those firms which have uncomfortable news or performance from one quarter to the other instead of a year, is there any visible shift in the shareholding?
Yeah, sure. So in terms of your question, yes. So there is this other paper that uses the exact same setting, and they were one of the first I think it's JF in Agarwal et al. What they do is that they show that after this disclosure frequency was increased for mutual funds, mutual fund holding time decreased. And so they would exit positions faster. And what they also showed is that their behavior of actively managing results in a liquidity drop for the firm and a sustained valuation drop also for the firm. So what they don't show is who buys on the other side from these firms. Where they stop is they show that it has a detriment. Investors do change the way they behave after this happens. This group of investors do change their behavior. Okay. What they don't get into is who comes in to fill that. And they have some discussion about how retail traders are more likely ones to buy it on the other side, but they don't get into the depths of that. But going back to the other 2 points.
Yeah, this is where I thought I have a supplementary point rather than a question. Is there a change in their voting pattern on decisions, once they are bound to disclose more frequently?
Yes. So what they find is that they hold firms that don't invest in R&D. They stop holding firms that innovate in general. They want firms where they can easily see value, and that gets reflected in sort of price. Okay. That's what.
Yeah.
But those 2 other points are well taken. In fact, that's exactly our point also, which is it's hard to believe short-termism can be a problem given that you've got private equity and venture capital funds flowing into loss-making companies. You got it's hard to believe that, and also companies are growing over time. So if you look at the Steve Kaplan's thought piece, it mirrors a couple of points that you just brought out, and I am with you in that I too don't completely believe the short-termism that short-termism exists. I'm just taking it as given from the prior work to tell them that I don't see why it should exist, also because of this angle. So there are 2 other angles why short-termism may not exist, as you rightly point out. There is another angle that I'm coming in and saying, well, there could also be some signaling that they can do to avoid the short-termism problem, even at the firm level. So at the aggregator level, we have these arguments, but at the firm level itself, it's easy to fend off these pressures. So I guess I'm on the same boat as you are, in that I find it hard to believe this working. As I said, it could be more like what Srini said, which is the managers are likely to cut for their own per consumption because of agency problems, which is a different issue than saying that investors are putting pressure on managers because of which they cut R&D, and this undervaluation is causing the problem.
So Karthik, I have a follow-up on just the discussion point that you just made, and maybe my main concern with the paper. See, so you have this exogenous shock, which is a regulation requiring mutual funds to report more frequently, right? And you know that after this regulation, mutual funds started trading in a certain way. They started buying certain stocks and selling certain stocks. Now, the paper that you cite, Cias and Whitby, essentially said, if you look at the paper, they said insiders provide liquidity to, institutions provide liquidity to insider trading or something like that. Right? So essentially, and so when as these mutual funds, because of the regulation, mutual funds start to change their portfolios. They buy certain types of stocks and sell certain types of stocks. And in response to that, insider trading is happening. So insiders are buying the stocks that the mutual funds are selling. For example, the high R&D stocks. So that is happening naturally, and that's why I have a concern with this statement that this is a signal. It's just that when mutual funds sell, somebody has to buy. The insiders are buying because institutions like, for example, they like high PE stocks. Insiders like low PE stocks. So that trading has happened. So it's not about signaling, really. It's just because of the way the regulation has caused mutual funds trading to change, and insiders are providing the liquidity. Right. So so that's why saying this is insiders are buying because they want to signal their type in response to that seems a little bit of a stretch to me. That's my main. Yeah.
One that tells you something about the liquidity issue. So first of all, if there is a liquidity effect, we were thinking that so if you believe that managers are providing support to the stock price, then that's exactly a signaling problem. That's not. If they buy their own shares because it's undervalued, and that's exactly the signaling problem, right? So in other words, I put my money in buying the stock that I believe is undervalued. If my firm is not undervalued, why would I buy? I would buy something else that's going to return value to me, right? So even if managers are going to sort of respond to lower or undervalued signal of their own stock by putting more money, that's exactly the insider signaling that we're talking about. So we both are talking about two coins, sort of two sides of the same coin. We call it signaling, but you're calling it insider purchases because it's undervalued, which is the same as signaling. Is there maybe I'm missing out your definition of a signal versus this?
Let me think about it, but
so if I have $1,000 with me and I'm thinking about investing it, why would I invest in my own company if I believe it's not undervalued?
I guess my trouble is with saying that these insiders are, because your regression is insider trading is regressed on this dummy treatment effect, which is some kind of a.
Trading I think it's better if you think of it as net purchases.
Okay, insider, net purchases.
Yeah, so they purchase more. Yeah. And that also shows up in, for example, that's why I put this up. Although it was just a backup slide, I didn't think it would come. But if you think about liquidity effect, it's not the liquidity effect that's driving. So one argument sort of related to what you said would be that managers are anyway doing whatever they want to do. It just makes it easier for them to do that because now you have more liquid securities because mutual funds are no longer holding. That could be a valid criticism against what we are documenting. That is, managers are already thought about buying and selling, but they were finding it harder to do. But now the market is easy because, all these stocks are floating around, I can do it. But that's not driving. You can see that what we tried to do was we tried to sort of control for contemporaneous Amihood liquidity, or if you look at purchases versus sales, we don't find results on the sales side. Generally, sales are more liquidity related and driven than purchases.
So let me just sorry. So the general idea is that insider trading and institutional trading tend to be negatively correlated. So when they buy, institutions sell, insiders buy. So you're showing that after this regulation, the intensity of the negative correlation became stronger in some way. Is that what you're showing?
That is correct. That is correct.
And you're interpreting that as in they are doing it because of this regulation, the intensity became stronger. And so there's a signal. They are signaling something that the firm is good. Is that the story in a way?
Yes. Yes. At least that is the channel that we are proposing.
Hey, Karthik, I have a question. So this is on the disclosure, right? So suppose imagine, let's say the disclosure requirement requires you 6 months interval. Anyway, so if the mutual fund is allowed to trade during that 6 months, right? It's just that the public doesn't know, right? So if the insider is really stepping up, sort of, supporting or taking the opposite side of a mutual fund, they would do irrespective of whether a fund discloses in a quarterly cycle or a 6 monthly cycle, right? So I think the question really is about the disclosure. So it's not about the mutual fund selling your stock and the insider taking up a liquidity on the other side, right, to support the price. So it's really not it's not a trading story. It is more it's something to do with disclosure triggering this whole change in the insider behavior, right?
That is true. It is the disclosure event that is triggering the whole.
So which is why I'm surprised. I'm also a little bit sort of puzzled because see really, so imagine a mutual fund doesn't like the stock for some reason, right? So and they are triggering a sale. So in a quarterly or a shorter frequency cycle, you're saying that they are forced to sell. So if you look at the previous, let's say in a longer frequency disclosure cycle, whenever you have a net fund sales, let's say funds are trying to reduce their holdings in a particular stock, do you find insiders stepping up in those cases as well? Because I mean, ultimately it's about funds reducing their holdings, and insiders are somehow coming up and stepping in the middle. So I'm just saying that if it had been a 6 monthly cycle, can you replicate the same kind of response by insiders when funds start reducing their holdings?
Yeah, so I would say that if let's say we had gone from annual to semi-annual rather than semi-annual to quarterly, by my prior is that we would find a similar result.
I mean, that could be a good counter test, right? To see whether it is, because my guess is that you have to disentangle the effect of the signal, which is the disclosure part. And the second part is whether there is any change in the fundamentals, right? I think because if it is happening at whichever frequency, it is just that it's now happening more often, right? If you shorten the frequency reporting cycle.
Correct. Correct. It will happen shorter. So yeah, if we get one more shock, which we could use where it sort of brings down the frequency or increases the frequency, then yes, it would be really nice because now we have only one shock, and will definitely give us confidence if, let's say, in a different frequency also, we are able to document that.
See, I'll give you a practitioner's perspective, and I used to trade similar things from a hedge fund. See, typically the only worry about a reporting cycle is other people copying you. Correct. So which is literally where, for example, if I had invested in a particular stock and there is an alpha that to be taken, but by regulation I need to disclose what I'm doing to others, then it's easy for others to piggyback without paying that cost, right? A cost of extracting information. So therefore I might drop certain kinds of stocks where the alphas are very very thin and they decay fast. So if the alphas are strong and they don't decay strong, then I don't care about that, right? So I think you may want to consider that aspect because that might be related to the disclosure.
Oh, yeah.
Because, I mean, because my guess is the funds are not dropping because, the fundamentals have suddenly changed because of the reporting part. So I'm a little bit not sure whether that's a good story if you tell to a fund manager. I think it's probably to do with it's easier for replication from others. And in which case, my alphas are going to be lost to others, very quickly.
I see. So, yeah, that could be. I don't think, that could be the alternative way to sort of position and to say that the reason why they drop these stocks is not necessarily coming from just the firm's own alpha going down, but also the fact that if I'm going to reveal my position and it's going to take me that much longer to generate the alpha, I would not want to hold on to that stock. I would rather dissolve the position and probably move to another stock where I can
exactly
sooner. Yeah, that's absolutely consistent with the story. That's sort of maybe that's a better way to put it. That these mutual funds, which are actively managed mutual funds, which would think somewhat similar to what a hedge fund would think as well, in that they are going to be worried about somebody front running or copycat traders who are going to come and take their strategy and going. And so if they're not going to see the benefits of the firms or their information processing in the firm quickly enough, they're going to get out of it, and then they're going to move on to the next firm. So that's definitely possible, and that either of these would result from a firm's perspective an undervaluation for that firm. And it is that problem that we are using. So your point is well taken in that it is the disclosure regulation that is causing the issue.
So Karthik, I think I would not make that inference, which is going back to Srini's point. There would be another trader taking that position. So the undervaluation, see, when it's more a liquidity issue, right? It's just that the mutual fund investors' portfolio may not have these stocks, but there could be other people who might step in to do that, right? It doesn't affect. It is just a liquidity story as opposed to more a valuation story. See, I'm just thinking, for example, right? If hedge funds get out of a stock, it doesn't mean that there could be a temporary price pressure, but somebody else will come in. I think that's the whole part of the markets being efficient, right? So I would not think it would change the valuation in a significant way.
Yeah, that would have been great, because then I wouldn't write this paper, right? So in a sense that that's what I believed too, in that there should be somebody else coming in and picking up that, and or as we discussed earlier on, some other investor like a private equity or venture capital coming in and pumping and resolving the liquidity issue from a firm's perspective. There should not be any of these problems. But the extant literature, or at least these 2-3 papers that use just this setting, their claim is that the markets don't support that. They actually show that there is a sustained undervaluation that results in a cutback on innovative actions by a firm. I don't know if we should not believe that, but if you take it by face value, that's what they are saying. They're saying that, yeah.
See, sorry, again, I'm also hogging the show here. The disclosure is only affecting mutual fund investors, right? Suppose you take a stock where mutual fund as a group are not the larger group of investors. So where at the margin, let's say other class of investors dominate, then you should see a much lesser impact in those stocks, right? So are you seeing that?
Yes, exactly. That's exactly what we do. So that is our control group. So our control group are firms that were affected by this regulation, but hold very little of a firm. So any firm that's exposed to less of mutual funds versus firms that have been exposed a lot to mutual funds. And so you're exactly right. So our control group itself is just that. So we find the effect is coming from the group, and that's why this setting is helpful in that we have this variation across firms on how much they are held by mutual funds, and hence how much they are affected. And I have some placebo tests where we find that, if you take hedge funds, for example, there they had a certain level of holdings, and this disclosure doesn't affect them, and you won't see any effect on this. So it's like a placebo test. I can show you that with hedge funds or other mutual funds, there were some mutual funds who were voluntarily disclosing this information anyway. there you don't find this effect. The effect is concentrated on the group where the disclosure mattered and where they were a large group of investors for that. So just one piece of evidence before I switch to. So yeah, so this might also help in sort of addressing some comments. So this is the paper that we use as our sort of starting point. This is a paper that puts forth the argument that when mutual funds are made to talk more, they have some career concerns because of which they are going to walk out of firms, causing an undervaluation problem. And then that results in firms not investing. So that's the link that we are not making. That's the link that's being made. We are able to replicate this, what they find, but it is puzzling, right? You would expect that some other part of the market comes in and alleviates that problem, and that's not what they documented. And when we try to replicate, we do find what they say, right? So it is right that when mutual funds sort of are asked to talk more and they come under these pressures where they need to generate alpha over a shorter period, and they are not able to show that in stock returns, they don't want to disclose their proprietary information on whom they are holding, they do find that these guys exit, the price drops, and managers don't invest. So that's sort of the existing starting point for us.
Karthik, you actually have only 5 minutes left. Sorry, we just.
That's fine. No problem. No, it's great comment. So I'm just going to very quickly tell you that here is the anecdotal example of Deutsche Bank's CEO saying that he's going to spend 15% of his salary on buying the bank share up until 2022. He made the commitment in 2019. And his point was to say that the stock is highly undervalued. We're making some long-term investments, and I will see. So that's the idea, Srini, that we are going for in terms of. So I think the setting, I think we spoke a little bit about it. I'll be very quick because we have 5 minutes. In 2004, we moved from a semi-annual to a quarterly reporting at the fund level. So now it's not at the institution level, but each individually managed portfolio level, you get information on how that fund operates, which is a lot of proprietary information on the trading strategies. And so that puts a lot of pressure on the fund managers to manage their portfolio well, which means they are not going to be even a little bit patient with stocks that are not going to deliver returns in the short run for reasons that could be either because of their performance concern or copycat, as Winky pointed out. It could be either of those. So what we did was we compared two groups, pre and post regulation. The group where a lot of mutual funds hold that firm, and a group which has very little mutual funds holding that firm. So clearly the effect or the pressure is going to come from the group with more mutual funds holding it. All right, so mutual funds holding it, and we are going to relate that to the net purchases on the other side, right? And so what we find, and very quickly, is that net purchases increases. So in general, the percentage of purchases that managers make in their own firm increases by 13%. And we can do some identification, and going back to some comments, Venki's comments, and also Joshi's, that there are other hedge funds and others who operate in the stock. Even if you look at their behavior, that doesn't affect. So the regulation does not affect their behavior. It's the mutual funds. So you can clearly point out that there is an effect. But what's less obvious, and that's where some of the concerns have come up, is how do we interpret that? So what, right? And can we close the loop on it? What we can do is that we are able to show at the moment that when insiders do trade, it does elicit a favorable price response. So market is looking for that signal. If they do that, whether mutual funds stay with the firm is Srini's question, and I don't have the answer to that yet. I can go and try. But going back, I was just thinking that we're able to correct the undervaluation problem more than anything. We do find that though, it is the CEO's incentives. Again, it's sort of a point that Srini raised earlier on. it is the CEO's incentives that drives the story more than investor-driven myopia. So if you look at CEOs who are also myopic, for example, they have high bonus component or their tenure is sort of short, there is high performance sensitivity to their turnover. Under these circumstances, they actually don't buy. They go with what the mutual funds want, which is cut back on R&D, try to give what the market wants. And we see a little bit coming, a stronger effect coming from those firms where they invest. So in other words, firms that undertake investments are the ones who signal, which is consistent with the John and Lang and the John and Mishra sort of papers. So that's what we have. So I'll stop it here. I know we are out of time. Thank you so much for staying with me this evening. So what we are trying to say, and I think most of us here agree, but still there are papers out there which says that short-term is a problem, right? I mean, while short-termism may be a problem, what they don't debate on is what are the conditions, are there ways for managers to deal with it if they want to? And we are trying to say that, well, look, they could signal if they want to. And we show some evidence saying that they are in fact trying to do that. We should do a little bit more in terms of showing that investors do change their behavior, which we will try to based on the feedback we receive. But what we don't do, and it would be nice for people to do, is we don't show, and even the other papers don't show an effect on aggregate investment. All that they talk about is at the firm level. It could just be a reallocation of project from one firm to the other firm. So the economy is really not affected. So that nobody talks about, and we don't have any evidence on that. And that would be something nice to show, especially in a setting like India where we have private company data as well. All right, so thank you so much. And
I think I have a couple of comments before, just quick comments in terms of cuts of the data. One is I was surprised you didn't look cite Boucher's, the style, different mutual fund style work. Reason is, the natural thing I thought was when you have a firm which is dominated by mutual funds who are momentum players, for example, they are the short-termists, right? So if you cut the data based on managerial mutual fund style rather than just the level of the ownership, level of mutual fund ownership, which is of a certain style, and see if insiders tend to signal more there, right? So that would be one thing. I don't know if that's a well thought out idea, but that just occurred to me. The other is this cost of signaling. Your idea, why is it a cost? It's a cost because when you buy more stock buy more of your own stock, you become under diversified. You're holding more of your company stock. So if then that means you may want to cut the data based on the level of inside ownership, where it's one group where the signaling is really costly, and see if that you see more buying there, right? If it's a really good signal. So those would be some thoughts on.
Definitely. The second one, I think we can definitely do that. The first one with the Boucher classification, there are a couple of issues. One, the Boucher classification is applied at the institution level rather than at the fund level.
Oh, I see.
And also now there has been some pushback on the measure. Nobody believes that measure as much as they used to before, because they use holding time to infer. So what we have cut on is active mutual funds. So we don't take, for example, passive mutual funds. These are mutual funds who are active, and only those would form our treatment group. So by definition, you can think of them as transient group.
Okay.
Analogous, not identical, but sort of analogous to that.
Okay.
So that would be the group we focus on. The other reason why we can't, so you could say, why don't you apply the same algorithm to the mutual fund level? The problem with that is we don't have mutual fund data prior to this point. So we have it at the quarterly level only after this point.
Okay, fine. I understood. Fine.
That cut is not possible, but the insider trading cut, we've definitely tried it. So both the insider trading cut and whether the mutual funds change their position after because of this action, we will definitely try both of them.
So thank you very much, Karthik. I'll see if there are any other comments from the group here. Any comments or questions?
I wish we could spend more time talking in person. So
yeah,
the next opportunity we get to do so, I'll definitely see myself in London, in Bangalore, excuse me, and I hope to meet several of you. Many of you have joined from other places, so if our paths cross, it would be wonderful to chat up. And so do Anish and Anil, do send me when you are ready and in the job market. Do consider RISE as a place. And
I am behavioral, so I think both of us are behavioral people. So I don't know how RISE is.
Yeah, we might not be the best place because we can't support you at that. You need an infrastructure that probably UT Austin or Emory would give that we will not be able to give. So yeah, but we should still try. See.
Yeah, I mean, if we're going to apply everywhere, considering how the market is going. So any college is fair game, I guess.
Right. No, I mean, there are some places where we would have resources, but at an early stage in your career, you do want the senior faculty guidance who have experience in that space. And that's where
go ahead.
And that's where I think probably we might be lacking.
Yeah. No, actually, I saw some Wharton actually doing some behavioral stuff, which is quite interesting. Like you don't expect Wharton to do behavioral research, but
so behavioral experimental, right? Are you saying behavioral?
Yeah. Behavioral experimental. So Wharton, I think there was a paper from Wharton which actually ran a JDM kind of survey, the kind of stuff that I do on some. So they don't call it an experiment; they call it a survey. But essentially, it is what it is a JDM, a Kahneman-Tversky kind of experiment that they're doing, which I found to be quite interesting. So I guess more schools are probably thinking of this, which is good for us.
Yeah, absolutely. I think it's an interesting space, definitely underexplored in accounting, I would say.
Thanks a lot, Karthik, and appreciate your time and interesting paper.
Yeah.
So one question we have have recorded this session. Is it okay for us to post the recording on our website?
Yeah, absolutely. That'll be great for me also. I saw that it was recorded, so I didn't have to note down everything. So I could now go back and I always like that. They give also a transcript sometimes, so it's great.
Great. So have a nice evening in London and nice evening to everybody here. Thanks for attending.
Yeah.